Hi viewers, I am Dr.S.Chandra, Assistant Professor of Commerce, Sri Sarada College for Women, Autonomous Salem. Now we are going to discuss the sources of finance. Before we are going to discuss the term source of finance, first we know what do you mean by finance. Finance is the lifeblood of every business organizations. Without finance, we are not doing any activities in the business. It is the major part in running a business firm. Distribution of finance to each and every department is based upon the requirements of that particular department and the situation of the business concern. It is also defined as the management of money, and it includes various activities like investing, borrowing, lending, budgeting, saving and forecasting of funds. Now we are going to discuss the term short-term finance. Short-term finance refers to financing needs for a small period of time, normally less than a year. In businesses, it is also called the working capital financing. This type of financing is normally needed because of uneven flow of cash into the business, the seasonal pattern of business and so many situations. Now we are going to discuss some of the sources of short-term finance. The sources of short-term finance like trade credit, bank credit, customer advances, installment credit, commercial papers, depreciation fund, provision for taxation and outstanding expenses. First, we are going to discuss the first sources, trade credit. Trade credit is an important external source of working capital financing. It is a short-term credit extended by suppliers of goods and services in the normal course of business to a buyer in order to enhance sales. It arises when a supplier of goods or services allows customers to pay for goods and services at a later date. It has some of the merits. It is easy and automatic sources of short-term finance. It also reduces the capital requirements. It helps the business people to focus on their core activities. It does not require any negotiation or formal form of agreement between the persons. It has some of the demerits also. Trade credit is available only to those companies they have a good track record of repayment in the past years. For a newly established concern, it is very difficult to finance working capital through trade credit method. And it is also very expensive when we are not able to pay the amount on the due date. Then we are going to discuss the second sources, bank credit. The term bank credit refers to the amount of credit available to a business or individual from a banking institutions in the form of loans. Bank credit is the total amount of money a person or business can borrow from a bank or other financial institutions. It have four types. The first one is loans, second one is cash credit, third one is overdraft, and the last one is bills discounted or bills purchased. Now we are discuss one by one. The first one is loans. Loan is an advance with or without security. A lump sum is given to the borrower at an agreed rate of interest. The borrower has to pay interest on the total amount whether he withdraws the full amount of the loan or not. The loan may be repaid in lump sum or the installments. Loans may be term loan or demand loan. The term loan is allowed for a fixed time period, whereas a demand loan is payable on the demand and is therefore for a short period. Then cash credit, it is an agreement under which the borrower is allowed to borrow money up to a specified limit. Cash credit limit is fixed after taking into account the paying capacity and credit worthiness of the client. The credit is given in the form of cash, usually against some security or guarantee. It is very flexible source of working capital. The borrower can withdraw money as and when required. He has to pay interest on the amount actually withdrawn rather than the total amount sanctioned. Then we are going to discuss the term overdraft. It is a facility allowed by a bank to its current account holders. The account holder is allowed to withdraw up to the certain limit over and above the credit balance in his current account. It is for a very short duration, generally a week, and is used occasionally. The last method is bills discounted or bills purchased. The customer having a bill of exchange arising out of a trade can discount the same with a commercial bank. The term discounting of bills is used in the case of time bills, whereas the term purchasing the bill is used in respect of demand bills. The bills discounted have some of the merits and demerits. The first and foremost advantage of business bills discounting is that businessman gets the cash immediately for day-to-day activities of the business. Another benefit of bills discounting as far the banks as are concerned is that banks earns commission on the bills discounted and it leads to extra income for the banks. As far the businessman is concerned, there is no need for collateral security and there is no additional burden of mortgaging